Welcome to the Deep Dive. You know the drill. We take the most critical financial and strategic sources, cut through the noise, and deliver the concentrated knowledge. Today, we are deep diving into the Cloudflare Q3 2025 earnings call. That wrapped up after market close on October 30th.
Right. And this call, it felt pretty critical, set against this backdrop of huge market enthusiasm around security, edge infrastructure.
And AI, of course.
And the massive opportunities with AI, exactly. So when a company's right there at the intersection of those three explosive areas,
Right.
The pressure to execute, it's enormous.
So high expectations going in.
Very high. But look, management didn't just meet them. I'd say they almost redefined them. The results really showed that their strategy, the platform, breadth connecting security, network, app development, it's translating directly into faster enterprise bookings.
And the market definitely agreed. That reaction the next day.
Oh, yeah. Spiked over 13%. It confirmed that, any lingering skepticism pretty much evaporated, replaced by some real bullishness.
Okay, let's unpack the numbers then. The ones that drove that swift reaction, it was a classic double beat, right? But maybe with some better underlying quality.
Absolutely, more than just headlines.
So starting top line, revenue came in at $562.0 million. That nicely beat the $544.7 million consensus.
And crucially, that's 31% year-over-year growth.
Which is acceleration, right? Second quarter in a row.
Second consecutive quarter of acceleration.
Right.
Yes, and that acceleration, it was highly profitable too. Non-GAAP EPS hit 0 and 27 cents.
Topping the $1.23 consensus. Solid beat there.
Yep, by 4 cents. But look, while revenue growth is exciting, for a platform company shifting to these huge enterprise deals, you gotta look forward.
Right.
And that means digging into cash generation and really importantly, future bookings.
Okay, so on the cash side, they showed pretty strong operational discipline there too. Free cash flow, FCF, was robust, $75 million.
Which translates to a healthy, 13% margin?
13% margin, yeah. But like you said, we need to look at the pipeline.
Which brings us straight to RPO.
Remaining performance obligations.
Right, RPO. Arguably the single most important metric here. It's the total value of those, non-cancelable future contracts. Signed, but not yet revenue.
Future visibility.
Exactly. The CEO talked about building the rails for the next decade of internet growth. And RPO, that's the tangible proof.
Yep.
Total RPO shot up 43% year over year.
43%. Wow. That feels staggering. Why is that particular number so significant?
Well, because that's the highest RPO growth they've reported since 2022.
Okay.
It signals real strength in large, multi-year strategic deals, contracts that basically de-risk that future revenue path, even the current RPO.
Stuff hitting revenue sooner.
Yeah, the portion expected in the next 12 months, that grew 30% year over year. So you combine that booking strength with non-GAAP operating income hitting $85.9 million. That's a 15.3% margin. You're seeing the ideal picture, right? High accelerating growth and clear operating leverage.
Okay, so moving beyond the raw financials, let's talk about the customer base. This is where that story, that narrative about transitioning to a true enterprise platform really starts to gain credibility. They ended the quarter with 4,090 large customers. Those are the ones spending over $100K a year, up 23% year over year.
And the quality of that revenue keeps maturing. Revenue from those large customers, now 73% of the total.
Up from 67% last?
Up from 67% in Q3 last year, yeah. But the really critical signal of platform value, that's the dollar-based net retention rate, DBNRR.
Right. For listeners maybe familiar with the term, but not the acceleration bit, can you quickly remind us what DBNRR really signals here?
Sure. So DBNRR measures how much your existing customers spend this year compared to last year. So it is. When existing customers aren't just staying, but actively spending more at an accelerating rate, that proves product stickiness. It proves they're successfully cross-selling the platform's other services.
And that expansion seems focused on the really high-value accounts, too. They mentioned this was the fourth straight quarter, adding a record number of customers spending over $1 million.
And $5 million annually.
And $5 million annually, yeah. Consistent execution at that high end. That's tough for a company that started more, product-led growth.
It really speaks volumes about the credibility of this go-to-market transformation they keep talking about.
It's not just talk then.
No, this isn't just marketing spin. We're seeing hard proof. Sales productivity up for the 7th straight quarter, and the net capacity, the size of their sales force, grew at its fastest pace in over 2 years.
So they're investing to support that shift.
Exactly. That's the organizational investment you need to shift from, simple product buys to these complex multi-year enterprise deals.
And in part of that transformation, they highlighted something called pool of funds contracts. What are those exactly, and why are they a good sign?
A good question. A pool of funds contract. It's basically a big commitment from a major customer to pre-fund future usage across the whole Cloudflare platform.
Like a prepaid balance.
Sort of, yeah. The customer commits capital up front, guarantees a spend amount, and then they can draw down on any service, security, workers, network stuff over the contract term. They said these now represent low double digits of total ACV.
Okay, so why is that important?
It's important because it means the customer sees Cloudflare as a long-term strategic partner, not just a vendor for one specific thing. They're betting on the entire ecosystem.
That makes sense. Okay, let's talk strategic wins, especially where they're differentiating themselves, which seems to be increasingly in AI and zero trust. They landed a massive 3-year deal worth $22.8 million with a global 2,000 digital media platform.
And the key differentiator in winning that deal, it was AI. Cloudflare positioned itself as the forward-looking partner. And importantly, it created a direct on-ramp for what they call paper crawl.
Paper crawl. That sounds interesting. Feels like it changes the relationship.
It fundamentally changes it because instead of just being a cost like security or CDN services usually are, they become part of the customer's revenue generation. They facilitate this agentic data consumption.
You mentioned that term before, agentic commerce.
Yeah.
Can you clarify, just in simple terms, what management means when they say AI is triggering this information consumption platform shift away from human eyeball traffic?
Yeah, absolutely. Think about the internet model we have now, advertising, right? It's mostly based on how many human eyes click on links or see ads.
Right. Eyeballs.
Agentic commerce is the shift towards transactions and content consumption driven by autonomous AI agents or bots. Not humans scrolling screens. Cloudflare is building the infrastructure where these agents can securely crawl, consume data, maybe even transact without a human directly involved. And if they can charge for that automated crawl and consumption, that's the paper crawl idea, they pivot. They go from being maybe a network cost center to being an essential AI utility. That's a massive potential market shift.
That is a huge structural change to think about. Wow. Okay, beyond AI, we also saw their zero trust, their SASE strategy, landing major public sector wins. A U.S. cabinet-level agency standardized its whole network and security platform on Cloudflare's FedRAMP portfolio.
That was a big one, 2 years, over $20 million contract, and it displaced over a dozen legacy point solutions.
A dozen?
Yeah, this is that consolidation narrative playing out. Enterprises are just desperate to simplify their security stacks, and the unified zero trust approach. It makes the total cost of ownership, the TCO argument, really compelling.
And speaking of TCO, that brings us back to one of their biggest weapons, right?
Yeah.
Killing those egress fees.
Oh, yeah. It's the Achilles heel of the big hyperscale cloud providers.
Yeah.
Cloudflare explicitly called out a customer who moved off a hyperscaler and cut their TCO by over 30%.
30%. Mostly by avoiding those data transfer fees.
Largely by eliminating those really painful egress fees. It's a powerful lever in winning deals, especially enterprise ones. It positions Cloudflare as this essential, kind of neutral, connective layer in a multi-cloud world. They highlighted their Oracle OCI integration as supporting that idea too. They're really challenging that traditional cloud spending model.
Okay, so if you tie all these wins together, the strategic deals, the accelerating customer metrics, it explains the confidence in their guidance.
Absolutely.
They hiked the full year 2025 revenue guide to $2.143 billion, raised non-GAAP EPS to $0.91, and Q4 revenue guided to $589.5 million.
All strong. But the real fireworks, I think, came from the CFO's longer-term projection.
Ah, yes, the big one.
They are now targeting a $3 billion annualized revenue run rate by the fourth quarter of 2026.
$3 billion. By Q4 26, that is highly aggressive.
It's wildly ambitious, yeah. That kind of acceleration, it requires near-perfect execution for the next, year and a half?
So what needs to happen for them to hit that $3 billion mark? And doesn't setting a target that high just put immense pressure on their already premium valuation?
That's the critical point, isn't it? That target demands that the AI workloads really take off quickly, that the enterprise sales engine keeps breaking records, that the whole zero trust migration accelerates globally. It definitely implies huge confidence in their product market fit, their pipeline visibility.
Risky.
Well, while it validates the thesis that they're taking share, you're absolutely right. It raises the execution risk significantly. If they miss that implied growth trajectory, yeah, that would certainly expose them to some serious valuation pressure, despite how strong this quarter was.
And adding maybe a little more pressure, or uncertainty at least, we have to talk about the leadership change they announced. CJ Desai, the president of product and engineering, is stepping down, effective November 7th.
Right, going to be CEO at another public tech company.
Yeah. So in a period with these aggressive targets, rapid product expansion, losing a key leader like that, it's definitely a watch out.
It certainly is, especially given Desai's role in driving that whole platform strategy. Now, management was quick to reassure investors. They stressed their confidence in the, deep bench of engineering talent they have, claimed that the customer-obsessed DNA he helped build will stick around. But still, anytime a key product visionary leaves right in the middle of a huge push into new markets like AI, yeah, investors need to watch that closely.
Makes sense. Despite that uncertainty, though, analysts seem largely bullish still. Truist put a $275 price target on the stock. TD Cowen's at $265.
Yeah, the sentiment is strong.
But the consensus seems to be, as Jeffries flagged, that the premium valuation is still the main counterpoint.
And that's really the crux of the investment puzzle right now, isn't it? Stellar execution justifies a high valuation, but any stumble could mean a swift correction. The market is pricing in continued acceleration, mostly driven by those high-margin SASE zero-trust deals, and increasingly the uptake of AI workloads.
Okay. This brings us perfectly to our high conviction segment. Given this sustained acceleration, the raised guidance, the aggressive $3 billion target, how might, let's say, sophisticated investors look to capitalize on this bullish story while maybe hedging some of that risk from the premium price?
Excellent question. And that brings us to the conceptual trade pitch.
Okay. And just the standard reminder here, the views we talk about in this segment.
Yeah.
Purely for entertainment discussion purposes, we're not regulated financial advisors. This is definitely not financial advice. Investing involves risk. You could lose your principal. Always do your own research.
Absolutely. So look, the market reaction clearly validated that the acceleration, the enterprise momentum, it's real. But like we said, the premium valuation means just buying the stock outright is expensive.
Right.
The options market, which prices in future volatility, is signaling high anticipation of big moves. So the conceptual trade here is about structuring a position that minimizes your upfront cash, but maximizes your exposure to that long-term growth story they just confirmed.
Okay, so less about the exact mechanics, more the strategic thinking.
Precisely. The strategy involves kind of using that volatility against itself. Conceptually, you might sell a put option pretty far out of the money, maybe 9 to 12 months out, to collect some premium income.
Okay, selling a put. Betting the stock won't fall below a certain level.
Essentially, yeah. Expressing the view it's unlikely to fall substantially below your chosen strike. Then you immediately use that cash you received to purchase a longer dated call option, say 12 to 18 months out, to capture that potential upside.
Okay. So you're leveraging the market's own high implied volatility, using the premium from the put sale to basically fund your long exposure through the call option. Banking on those, say, $275 price targets being hit as SaaS and AI really kick in over the next year or so.
Correct. It's a mechanism, conceptually, to play for that confirmed growth trajectory and that ambitious $3 billion target without laying out all the capital for the stock up front. It acknowledges the premium price, and you effectively get paid a bit to wait for the fundamentals to play out.
A very interesting structure. Okay, this has been a fascinating deep dive. Cloudflare delivered an extremely strong Q3. We saw accelerating revenue, record strength in those big customer cohorts, and undeniable momentum in key areas like AI and zero trust.
All backed up by that raised full-year guide and, of course, the very aggressive $3 billion annualized revenue target for Q4 2026.
Right.
But the key structural takeaway, the thing you should really mull over, is that shift they talked about from human eyeball traffic to agentic commerce. This isn't just a tech change. It could be a fundamental shift in the internet's business model. And it positions Cloudflare's platform as potentially the utility layer for all these AI transactions. The big question now is, given that 80% of leading AI companies are already using their platform, how quickly will these AI-driven business models really scale? And what kind of competitive pressure does that put on the legacy network and cloud players over, say, the next 18 months?
A genuinely compelling prospect to track indeed. Thank you for joining us for this deep dive into the Cloudflare earnings call. We hope this summary helps you navigate the complex world of market dynamics and these big technology shifts. Catch you next time.